Financial management. Management is the process of setting and achieving objectives by delivering basic specific functions in managing and using the organization's human, material, and financial resources. Managers are those who have the authority to make decisions by which resources are spent in order to achieve the goals of the firm. Management involves people's activity. Managers work to achieve goals through members of the organization. In order to reach the set goals, managers have to fulfill some basic functions, namely planning, organization, motivation training, coordination, and control. Management involves the manager's conscious decision regarding the setting and realization of objectives. Decision-making is the critical part of all managerial activities. Decision-making can be intuitive, even arbitrary, or on the contrary, based on knowledge, ideas, rules, principle, and much more. The delegation of responsibility only works if the delegate remains responsible. One of the resources that is the subject of management is the financial resource. Accounting for a company. Commercial companies and other legal profit-making entities have the obligation to manage their own accounting. Accounting can be defined today as a set of rules and procedures that need to be followed to quantify, process, and communicate information, predominantly of a financial nature, about an identifiable economic entity for the purpose of adopting economic decisions. The double-party system is based on a principle of duality, according to which any economic fact has two aspects: resource and use, consumption and income, effort and outcome, compensating or balancing each other. With the development of joint stock companies, where the separation of business leadership from their owners creates a new aspect of accounting. It was designed for leadership undisclosed, bound by general accounting, accounting for shareholders. Management accounting provides all the accounting information that is quantified, processed, and transmitted for internal use by managers. Managing accounting, also called analytical or managerial accounting, serves as an instrument in decision-making by the company's manager. Management accounting has the function of determining costs on products, activities, and organizational units. It also provides the information necessary for the preparation of the forecast budgets. Financial accounting provides accounting information that, in addition to internal use by management, is also communicated outside the organization. Financial accounting, also called general accounting, consists in recording all operations affecting the patrimony of the commercial company, to determine the patrimonial situation, to determine the financial results internally. Financing account is a tool for informing management of the unit's patrimony, but it's also a useful analytical and synthesis tool to ensure effective control over economic governance. On an external basis, financial accounting is a tool that enables third party to be informed about financial results of the entity. Legal entities prepare simplified annual financial statements consisting of balance, profit and loss account, accounting policies, and explanatory notes. According to the accounting law, responsibility for the organization and management of accounting is the responsibility of the administrator or another person who is required to manage the unit. According to FIRS, through cash or cash flows we understand cash inflows or cash outflows of cash and cash equivalents during a financial year. The cash flow statement should present the cash flows over a period of time, classified in the following activities: development, investing, and financing. The companies are obliged to apply for the approval of accounting regulations on the individual annual financial statements and the consolidated with annual financial statements for the approval of simplified accounting regulations. Required bookkeeping registers. It's like the ledger, inventory ledger, and general ledger. The ledger is a mandatory accounting document in which all economic and financial operations are recorded in chronological order. Operations of the same nature carried out in the same place of activity can be recapped in a centralizing document called auxiliary journal. At the base of the journal entry, any record in the ledger should include items on the type of justification document, the number of supporting documents, the date of the supporting documents, and the explanations of the respective operations and the synthetic debtor and creditor accounts in which the amounts corresponding to the operations were performed. The inventory ledger is a mandatory accounting document in which all the assets and the liability items, grouped by their nature, are recorded according to the law. It is drawn up at the establishment of the unit at least once a year during the operation of the unit, during the merger, or during the division or termination of the business, as well as in other situations provided by the law on the basis of factual inventory. This register shall include the items listed by nature which are sufficiently detailed to justify the content of each balance sheet item. The general ledger is a mandatory accounting register in which it is recorded monthly and systematically by regrouping the accounts, the movement and the existence of all assets and liabilities at a certain point in time. The general ledger is a synthesis and systematization accounting tool that contains the debit account symbol, the corresponding creditor account symbol, debit roll, loan rolls, and account balance for each month of the current year. The primary objective of accounting is to provide information needed to make managerial decisions. The information provided by the accounting system is the basis of the decision-making process, both inside and outside the company. The quantitative information provided by accounting covers three functions: planning, control, and evaluation. Accounting provides useful information to investors, creditors, and trading partners to enable them to foresee or to compare and to evaluate the cash flows of the company's ability to generate profits, as well as the ability of the management to use the resources of the company effectively. Income, costs, and profit. Profit is the surplus obtained by a company when the total revenue it derives from all its activities exceeds expenses necessary to carry out those activities. Profit equals revenues minus expenses, when revenues are bigger than expenses. Here are some practical management tips for startups. Manage your accounting properly. It is essential to keep a clear record of revenues and costs. Analyze your costs. Track all your business's expenses. They can accumulate quickly, but the cost analysis allows you to monitor them. Make financial projections. Having a clear financial projection is important. Your core business plan helps you anticipate potential risks. Do not be negligent with your billing. Always monitor sent bills. Keep business records. Keep an accurate record of your personal money borrowed from your business. Manage your financial resources effectively. Set your personal salary as low as possible and include the minimum state required benefits. What you're saving at the beginning of the business will give you more flexibility in the coming months. Keep travel costs to a minimum. Manage your legal and judicial costs carefully. Ensure that the expansion is consistent. Rapid expansion can cause problems throughout the activity. Manage marketing and PR policies. Consider renting instead of purchasing. Accessing non-refundable grants programs or benefits for certain categories. Securing capital. Effective management of production, resource, marketing, and costs.